Hello ladies and gentlemen, if you're watching this it means you've decided to get to know a little more about Forex trading. Welcome.
The currency market is only one part of a huge world of exchange where everything is a commodity, from wheat to diamonds. It's a world of hopes and disappointments, a world of passion and cold calculation. Untold wealth is made here. This is a world of strong, decisive people, people who do not look at life through rose-tinted spectacles. There is no place for illusions here, though, paradoxically, what are traded on the exchanges are as intangible. We deal in beliefs and expectations. But wait, I'm getting ahead of myself. Let's take things one step at a time.
Foreign exchange trading. Let's consider the main thrust of this phrase, exchange trading. How did it appear? What is the modern exchange? And what is traded here?
The modern stock exchange is the highest form in the long evolution of global trade. Merchants and traders gradually developed from working in caravans and noisy bazaars to organizations like stock exchanges. In the Middle Ages, merchants only met at a certain place once a year, at fairs or markets. But nation-states and new trade routes were being developed. New continents were being discovered and new goods were appearing on the market. Cities and populations prospered with this boom in trade. In large seaports, like Antwerp, trading began to take place on a daily basis. Initially in the open air, and then, later, in buildings specifically designed for this purpose. One of the first European stock exchanges opened in Antwerp in 1531. Over the years, a set of rules governing exchange trading grew up, and in the most developed economic nations, these rules are enshrined in law. Modern stock exchanges are a major element of the global economy.
We've already given examples of things that can be traded. Commodities like gold, or petrol, or currencies, and of course there are things like shares and bonds. We're going to divide these things into three groups, depending on which exchange trades on them.
The first group is the commodity exchanges. These were the first exchanges and evolved from the quayside and markets. Nowadays, however, they do not trade in real goods anymore, but in obligations to buy or to sell certain amounts of goods at a certain period of time. These obligations are in the form of future contracts, forward contracts and options. To cut a long story short, this is a trade in expectations.
Without these expectations, it would be impossible to carry out real long-term contracts. Modern life would be impossible without the commodity exchange.
The second group of exchanges deals on the stock market. Here we have a trade in paper. Not just any paper, of course, but financial paper, such as securities, contracts, bonds, and other complex financial tools. Modern stock markets are an economic thermometer measuring the temperature of the global economy.
The third group is the currency exchanges, the group we're most interested in. Currency is traded on them. One nation's money is exchanged for another's. Today we shall explore exactly how these transactions are carried out. But before rushing into this business headlong and learning how to make Forex currency deals, we need to understand something about the global currency system.
World War II not only changed the political balance of power, it also left both Europe and Japan in ruins. In 1944, financial representatives of the Allies met in Bretton Woods, a small town in the USA. They discussed the problem of a post-war financial mechanism for the restoration of the global economy. To this end, the International Monetary Fund was founded. America agreed to peg the value of the dollar to gold. 1 troy ounce of gold was equal to 35 US dollars, and the other members' nations' currencies were pegged in turn to the dollar.
The dollar had taken the baton from the British pound, which had predominated international payments since the middle of the 19th century.
By the early 70s, the global economy was on the upturn. Germany and Japan, the defeated nations in the war, had developed into economic powerhouses. The dollar had ceased its gold parity for some time, and it was decided to temporarily suspend the Bretton Woods Agreement.
In life, nothing is as constant as the temporary, and by 1978, a floating currency system had been established.
Even so, today's prices for metals, petroleum and international debts are still in American dollars, because for the first 30 years after the war, there was simply no alternative.
It's possible to buy and sell money for money, just like any other commodity.
The payment for money is the interest rate which the seller receives. At a basic level, when you put money into your bank account, the bank is the buyer and you are the seller. The bank pays you interest for the use of your money. The money markets have been set up to trade in money. The participants of this market give or take money for a period of time at an interest rate. The companies, the banks and the state buy and sell money in the form of certificates of deposit, bills and bonds. These operations are made in the national currency.
And after the introduction of floating currency rates, national currencies began to go on sale for foreign money. That is to say that money had become a commodity, an exchange commodity.
Remember, one of the main properties of an exchange commodity is a way of gauging quality. The quality of a currency is measured by how far the national economy has developed and by the issuing state's ability to meet its financial obligations.